Every time this chart has gone above 50%, a recession has occurred in the US. But what does that mean for you as a trader, investor, or even tradevestor? Well, today we understand this a little bit better. And more importantly, we take a look at stocks, commodities, and cryptos ahead of the inflation numbers. Yes, in only a few days, we'll end up getting the inflation CPI report. And we know that this is the biggest data event of the month. It tends to break resistances or turn markets in a big way. So let's look at all the critical levels and get started. Well, welcome back everyone to the Daily Show where we talk about markets around the world. If it's your first time here, welcome. Consider subscribing and smash that like button if you find value in today's video. So let's talk about yield curve inversion. Obviously, the bond market and the stock market don't agree on certain things right now, and we have to pick a side. Are the stock market traders correct or the bond traders correct? Generally, I'd be going with the bonds, but let's dissect today in the video about what is the pros and cons for going with each and what timings we have to expect. So the yield curves are still inverted around the world, especially in the US. And we know that many different yield curves are inverted. The 3-month versus the 10-year, 2-year versus the 10-year, some of the traditional yield curves that usually show a recession is coming. But it can also mean that the length of when we have this inversion and how long it's been inverted for can actually lead on to how bad the recession length gets. And that's a very interesting fact. You can see here that some of the previous inversions from the 90s, 2000s, and even 2005 to 2007 have led into anywhere between 14 months, 18 months, or even very short ones such as 6 and 8. And we actually saw recession signals for a very short time in 2019 as well that led to, of course, one of the shortest recessions we've ever seen during the pandemic, with the Fed bazookaing the market to where we are now. So I've shared some charts over on our Twitter, and I do encourage links in the description down below if you're interested to get involved, because there's quite a few things that are occurring in this market, similar to some of the peaks we saw last year before markets got bad. One of the first things has to be leverage traders. Leverage traders are actually going against the market right now, and they do tend to eventually get it correct, but then they may deleverage it very, very quickly. In recent weeks, they've basically added tons of shorts. Now, this is similar to what happened in August of 2022, and we all know what happened after August. We got some pretty bad economic data, and then all of a sudden, the markets were down 15%. It doesn't mean it's going to happen, but it's an interesting signal. We also spoke about this at the start of the video, which is percentage of yield curves inverted. Now, this is something that I didn't always use. I used to use 2-year, 10-year, 3-month, 10-year, all the traditional ones most people do. But what about if you got all of the yield curves inverted and then put it on a chart? Well, it turns out it's 100% correct in terms of what it's done since the 1960s. So we've now started to cross back down. At the time of this recording, we're sitting around here on these particular charts. Now, you'll notice if you look at all these recessions, by the time we're actually in a recession officially, usually it's already gone back, way back down below the inversion itself. So it tends to be kind of like the canary in the coal mine. We know something bad's going to happen, but we don't know it's going to happen usually in terms of the market won't hit it until we cross back underneath. And I tend to find that we usually cross well underneath this 50% trigger before we even get the signs that are showing us that probably a recession is here. That's when we usually get that economic data coming out. Remember, unemployment also tends to spike up, so we tend to see jobs being lost, and that usually happens around 6 months on average before a recession is called. Now, there's a lot of words that come out of recession. Realistically, what you're looking at and all you care about is the market going up or down, and how much will it go up or down? So let's talk about some of those things right now. Heading into this week's data, we're starting to see people turning very bullish. In fact, most people are now saying soft landings here, it's all different, this time is different. Well, history says it isn't, but we'll find out whether you're correct or not. You can see here for the next 6 months, the survey results are showing that people are believing that 33% of people are believing it's bullish for the next 6 months, 31% are saying basically I have no idea, and 35% are bearish. Now, this is starting to get more in line with historical averages, and we've had this a few times, and I usually get incredibly cautious around these periods in time for markets. When everything looks absolutely great and you're at technical resistance, which we still are, this is when you need to be most cautious in markets. Just take this reading here from the end of March. You can see the differences of the bearish data and what's being shown there. Remember, it's a bit of a contrarian indicator, but it's a good way to look at it. We also know that smart money has kind of stopped purchasing. They've purchased the dips recently. Don't get me wrong. They've started selling a little bit into those, which is pretty traditional. And dumb money started to take over. Now, if we see dumb money spiking up heavily and we make a new high on the S&P, if we're hitting something like a 4,300 or a 4,350, that's been a very critical level for me for a very long time. So I'll be absolutely looking at that zone as very, very bearish. However, at this stage, we're not even close to that. We're obviously sitting just below that kind of 4140 zone. And this is where we find ourselves ahead of the CPI data. Usually we spike into those events, and understanding how news events work is very, very important. So stick around. We'll talk about that soon. Let's look at the actual asset manager inflows. Now, I consider between 600,000 and 400,000 to be basically a neutral market. And that's where the market's gone back down to. Now, they were selling, and take a look at this, they were selling way before 2022. They were actually net purchasing at a lower rate into that full bullish run. So remember, this is not it's going to happen tomorrow kind of thing. It takes time to actually occur. But they were selling for a very, very long time. And then back in July and October, they turned more towards the bullish side to try to get ourselves back to neutral. And this is what many people in the industry are talking about. They're basically turning neutral because they're not sure whether this time will be different, but they're prepared to have, I guess you would say, gunpowder ready if they need it, if the markets come back down, to give them a great opportunity. So I think that's something that's really important to notice. People are neutralizing so that if there is a huge rally and things get kind of 1920s, 1930s on us and we go into some ballistic rally, they're ready for it. But at the same time, they're certainly kind of cautious in terms of their asset allocation. Let's have a look at net percentage of domestic banks tightening standards. This has now come right back up, and you can see this huge shift towards credit tightening. This has occurred usually before every single recession, and it's a good warning sign. It shows us a recession's coming, and again, unlikely to be a soft landing based on everything that we've done. When retail sales go negative, a recession usually follows, another signal that's kind of going. And remember, people are ignoring every one of these signals, which is, I think, very, very interesting, because this is exactly what tends to happen if the markets are doing a great job of trapping people into that bullish sentiment. US ISM manufacturing PMI, again, another one crossing. When that goes below 45, we tend to see recessions soon following. We know that credit outlooks and tightening is occurring, and that's usually a big sign, of course, of a market that's basically a little bit sick. And this is kind of the way it works. We get curves steepening. Well, we've seen that with all of these interest rate curves. Then we get credit tightening. Well, that's happened since Silicon Valley Bank and Credit Suisse. Then we get a Fed cut. And remember, the Fed will pivot. They'll probably raise one more time, maybe 25 basis points based on what people are thinking. Then they'll pivot, which means sit it there for a while, and then they'll cut. And they're not going to cut out of the goodness of their heart. They'll only cut if they believe everything is really bad. And that tends to actually usually lead to further declines. Now, I'm always an optimist when it comes to the American market and the American economy. And in general, you have to be. If you're, always bearish in markets and you don't have some long positions, then it's very tough. Investing is very different to trading, which is very different to, leveraging up or dollar cost averaging or any of these types of things. So you have to kind of decide on what your style is and what you're going to do. And we'll just talk about one of the ways that I do that, or at least I consider that in markets. So we know that we're basically here. At the time of recording, we're following the no recession path, the soft landing, everything's great and everything's glorious. And it still could be, it's possible. Of course, the bonds market doesn't agree with this. So we could be following something like that. Now, if that happens, I actually worry about the future of the market. It's going to be very difficult to ascertain whether that's a false rally that's going to go really bad. What is actually preferable here is maybe something like this, new lows, and then slow recovery coming out the back. That would actually be a much more healthy market. But, nothing ever happens the exact way you wish it to, yeah? S&P 500 forward PEs. Now, this is something that's really important to keep in the back of your mind. I'm actually, again, very bullish. If anyone's been watching here for a while, you know I love Microsoft, one of my favorite stocks. And I also really like the American market, even though I'm Australian, as you can probably tell. I think it's the best market in the world. So if we're talking about forward PE ratios, at the moment, it's probably sitting about 18.6, 18.8. It's not exactly cheap, but it's not exactly expensive. I mean, forward PE ratios, you can see where it's been in the past, and you can also see where it gets really, really cheap. Now, anything below kind of 15 or in the 15s, I usually consider to be a pretty interesting zone to go along with 5 to maybe even 7 other reasons to be in the markets, breadth, thrust, all sorts of things. And at the moment, it's, I would say, average price. It's 16.8 is basically the average to 17.3. I wouldn't think it's cheap. I wouldn't think it's super expensive. And what you're seeing is a lot of people hedging their bets. Again, that's why technology's up. And they're going into it because the Fed balance sheet has also come up recently. Because this market's so manipulated, watch some of our previous videos before, you'll notice that really a lot of this has to do with the monetary flow from the central banks. And I'll bring up some new charts as we see, especially what happens this week based on the inflation data and the earnings reports, where we'll follow the Fed as much as possible because fighting them is not going to be worthwhile. A lot of other people are buying because of seasonality. Right now, April is one of the strongest months for S&P 500 traditionally, and it could again blow out. If we go past 4160, 4180, which we'll talk about later, then we're most likely going to push it to the 4300s, which we have to be aware of. But I still think this is the most likely scenario, and that is that lagging Fed hike impacts have been brought forward. We're going to see tighter credit conditions, which has happened in the past due to Silicon Valley Bank, Credit Suisse, etc. And we probably will start to see the impacts of this, maybe not in the current earnings, but we're going to see it in maybe the forward forecasts or even the next 2 to 3 months of data. I think things are starting to come forward quite a lot. And that's good news if you're a bear, because you're probably going to find out a lot sooner than you were. At the start of this year, it was possible that we'd go into 2024 and not even see any recession. It was starting to look that way. Now it might be coming third quarter of this year or even sooner. So you've got to be aware of that. So why am I kind of feeling like this? Well, I always pay attention to the bonds market. And why should we do that? Well, the VIX, which is the stock market basically, and the bonds market volatility is totally different. This is an old read here, but it's pretty similar still. And it shows us the bonds market's freaking out while the stock market's like everything's great. Traditionally, the bonds market has been correct. And if I was going to go with who's correct most of the time, I'd say the bonds market's like 8 out of 10. So it's pretty strong there. And if you have a look here, the S&P 500 after this cross has occurred in the past has been traditionally 50-50 kind of over a 12-month period. You've got some really big watershed moments, and you've also got some recovery moments as well, or sideways kind of things. So I wouldn't say it's like, even if you were coming back in 12 months, maybe it isn't going to be like an exceptional return. Maybe we're on the top end. Maybe it's only 6-7%. Well, you could get that almost in cash right now. So I think that the risk rewards are very important when you're considering investment versus, of course, trading at this point. We know that the Fed will only pivot, and usually they will only cut because they've broken something. This is the chart that everyone talks about. Fed pivots, bad things happen. I'm not thinking they're anywhere near this bad. However, yes, we do see the signs of cracking in the economy. And this time the difference is how fast they're prepared to re-inject money into the system. Remember, they are technically still tapering though, so we'll need to watch that very much. And make sure you subscribe, because I'll definitely take you on the journey of understanding the Fed better over the next 6 months. I think it's going to be one of the biggest watches. EPS forward growth is turning negative as well. Eventually, bad news will be bad news and good news will be good news. Now, when that happens, it's good because it means that you can actually start to pick the bottoms of the markets and the turnarounds. But when markets are loving bad news, well, that's really disturbing. I mean, that's the type of market that you don't really want to be involved in unless you know it's being driven by the Fed's balance sheet, which is partially what's happening right now. ERP is also something that we can consider. If we see recessions, we tend to see this ERP kind of thing come through. We'll talk about it again in the future, and we've done it a lot in the past. So not only do we have inflation numbers coming up, but we also have banks earnings coming up, and we are all eyes on their forecasts here and how bad this is going to be. If you miss tech, and let's say the market starts to recover through and everything looks good, usually there's a few sectors that are left behind. And I can tell you this, there's always another opportunity. I really want to make that sure for everybody, because if you've been trading for a while, please actually post in the comments down below to help your fellow traders and investors and trade investors and all these other people in this community, because it turns out that a lot of people feel a lot of FOMO because they love a stock. Your stock might be Tesla. Your stock might be Nvidia. Your stock might be Microsoft. And it goes up 40, 50%. And then all you can do is freak out about how you've missed that opportunity. And generally, it's because you have someone in your life that's telling you, how great is this? I made 50% in 2 weeks. Look at me. I'm the boss. They're not the boss. Don't worry about them. Focus on finding the next opportunity. Recently, I talked about utilities. Did they beat technology? No, they didn't. But did utilities do well? Well, we'll see later on the charts. And let's go into the rotation while we're speaking of that. 5-day rotation, utilities 3%, healthcare 3%. It's actually beating technology. There you go. So it's actually doing better than that. Energy also out in front, thanks to OPEC and their cuts. Then we look at the last 24 hours, pretty much flatlining here. We got a bit of industrial kind of moves, and the rest of the sectors were pretty flat. We actually saw a sell-off in the morning, which if you watched the previous video, I literally had that level sitting there and said, this is pretty much where I expect the sells to happen. They sold off directly from there. We hit straight into the demand, and then we saw a turnaround. Let's look at all of this right now. So we'll move over here to yield inversion. And I just want to reiterate one thing. We tend not to go, look at the dates here. We tend not to go into a recession until we actually see these things go back. So we should be expecting this to really cross back above this line, and then things start to get a bit worse. So just remember to keep things like US 10-year, 2-year inversion on your charts, and you're looking for the cross through. When that actually goes through, then you can start panicking and saying, well, where are the signs? Let's go looking for the signs and making sure that we're aware of the risks moving forward. Don't worry, I've got you covered on this channel. We'll be following that very, very closely now. Let's look at bonds, high yield debt. Market went up, bonds held firm in the high yield. So that's usually a pretty good sign. That's okay. I'd say it's neutralized into the core inflation numbers. We got TLT coming down a little bit. That's because of the US 10-year, which went back above 3.4. Remember, we still haven't really been able to get underneath that magical 3.322 on a weekly close, and we're looking for that, because once that occurs, TLT should theoretically go up quite a lot, and that could be as soon as the inflation numbers. Let's move over to copper. Copper also shows us, well, they call it Dr. Copper. It shows us kind of the strength of the economy. And the economy right now, it looks medium. I mean, I spoke about it here, and I've been consistently bearish on copper over the last couple of months. It's doing okay, but I'd like to see this actually fall through. If we see copper break back above this, I'll probably throw the trade for the time being and move on to something else. And that's just because I think that you've got to know when to keep something and know when to say, well, it didn't happen there. Let's move for the next opportunity. Sometimes people don't consider that. Would you still be in a trade if you looked at it with fresh eyes? Would you even want to be in it? That's something that we need to look at. Copper at this stage, though, still at that resistance, sold off over the last 24 hours. Certainly what I'm watching over the next day. Let's move over to dollar index. Now, dollar index may have come off a trend line. I'm not a huge fan of these types of trend lines, but yeah, it probably came off something like that. We get a little gap in here, I believe, which is, interesting. Usually we'll go to fill that later on. And I think if we come back into these kind of weekly levels, the 101.72 that I've got priced in here, I'd like to see dollar find bulls. Let's have a look at the daily close for dollar. And you'll notice it's interesting because it actually gapped above this tweezer. Now, all of this is not so much the trade that I liked, but gold was phenomenal. Oh, we tapped it, and we tapped it good. Congratulations, everybody. Absolutely. That's the bellissimo, yeah? Very, very nice. Perfect hit. And that was great to see gold come back off a level that we thought would find resistance at. Around that 2028 was the level I had. And then it sold off, and it came into a trend line with our fib, with a bunch of other complements that I'd found. And we also know that around this level was incredibly well traded. So finding buyers there is good. If dollar continues its weakness, then of course gold could go up, but this will be very sensitive to yields. If yields drop off like massively, I'd probably expect gold to go up, things like US 10-year getting destroyed and going back underneath 3.32. But if yields turn to the upside after this inflation data, you've got to be a bit careful here. So it was a great trade for the day. It's good to maybe descale or do whatever you're going to do with it. But yeah, risks are still there. And obviously we've got that switch. Let's move over to silver. You can see here with silver, it's holding its own. Silver's doing better than I probably expected. I'm watching it and we'll come back to that after the inflation number. Natural gas. Now, this looks like it might have lowered and it's got a great close here right above the highs of all these wicks. I like that. I think that the Widowmaker has done some good things. It took out people's stop losses again, so it definitely hunted everyone down here. This was a level we've been very patient for and we've waited. And I like kind of the action that it put through in the last 24 hours. I do think that's fairly strong. We now need a weekly close high. And, you know, stopping the freight train down of something like natural gas, as you can see here, this is not for the faint of heart. You know, to trade something like this, you have to expect 30% daily moves. And they call it the Widowmaker for that reason. So be careful here. But yeah, certainly a good 24 hours on natural gas. Now, US oil is waiting for the inflation numbers, I feel. It's consolidating. Whether that's an accumulation or a distribution, for all the crypto people, you know what we're talking about there. Yeah, because we got through that 30,000, or we got to 30,200. That's up to discussion. However, we do know that this is starting to range bound itself. So there probably is a break coming, and that should lead into a pretty good trade. So we'll move over from that one. At this stage, if you're looking at it because the trend is up, I guess you would go with the upside, but we'll find out with the inflation data. Now, let's move over to Tesla. Ooh, beautiful hit down to these weekly expected options lows. Love that level for buy the dip on the session. I can see why so many people would have bought that zone. Ultimately, you know, pretty good level for Tesla and a nice close for the day. And yeah, I'm probably kind of pretty happy with where it went to. Of course, inflation data will make the difference. And we still have these expected weekly options high zones as resistance if we start running really heavily. And down here, a closure below there, watch out because that's going to be very dangerous. I think if we get a closure below this level of 176 or around there, closure daily, we could actually move down to a zone that I've spoken about a lot, which is that 145. And I think we've got to be very careful of that over the next coming weeks and the data that's starting to come out. Weakness into beautiful day strength. IWM versus the SPY, very interesting ratio. We'll come back to this in another video, but I do think it's one to have on your charts. You can see the 2002 and the 2020. If this keeps weakening and breaks to a new low, I think that may be significant to what's coming in the markets. Maybe a recession is coming through. So that's going to be an opportunity. Let's move over to energy. We know that energy is at resistance, so that's pretty critical. Basically, it's at that 61.8 kind of turn. Again, waiting for the inflation numbers. What about utilities? It's been pretty nice. Utilities has had a great run on it recently. It hit my first target, and it looks like it's still getting ready to have maybe a little bit more of a ramp. I don't know if I'd enter it anymore, but yeah, it's an interesting zone and certainly a critical level. And what I really wanted to show here is that if you got even just this level here, it's still 8.28% out of something that most people consider a trash index. Well, it's trash until timing is everything. And that's one of the things I want to bring up there. RSP, this is, of course, the equal weighted S&P 500. This shows us really a better look at the S&P and the strength or weaknesses in the chart. 61.8, downward sloping trend line. Where do we find ourselves ahead of critical data? Right at the critical levels. So we're in the pocket area. We're basically in that trend line and we'll find which way it breaks. DAX is at the highs. Very strong kind of looking candles here with okay volumes through them. Basically, these are all showing that we should be going bullish. I mean, a lot of people are going to see that and say, well, that's a bullish signal. Yeah, it does look that way. And obviously it's a shorted index, but 24 hours inflation data, that might change the mood. Let's move over to the Australian market. The Australian market actually showed a little bit more strength. I thought about 7,200 would find a bit more resistance. We found some, and then it's broken above. Again, inflation data will probably change the game here. So Yeah, I'm not too sure on that one. I'll probably just leave it for now. Stop losses above here would have been triggered. Above here, obviously not triggered yet. So yeah, I'd probably wait for a little bit more information on that one. We'll recover it in the next video in some more detail. US 2000, this is the Russell. The Russell has shown some signs of life. It actually found a pretty nice little turn down here, but we're still stuck within two larger zones. This 1810 breakout close daily would be, I think, fairly significant towards the bull side. And of course, 1700. Oh, I want to set alerts for that one, because if that happens, well, we know what should be happening for the S&P moving forward, and we'll bring that up when and if it does occur. Whereabouts did we get with the Qs? We came back down to the demand, resistances becoming support, the standard role reversal concepts, and we found basically buyers recommitting. So we're doing all of this ahead of CPI numbers. Now, my thought process, I said, how is the market going to react? It could be the market goes like that. And if the market does something like this, or even if it initially goes off and then rejects, it'll be those rejections that actually you want to react to. So I'm thinking this is a possibility where the market's kind of go initially bullish, then bearish. That's certainly one. We have seen strength buying. It's going to be probably a fairly interesting data. I don't think it'll come through at anything in particular that's amazing. If it is horrendous and no one's expected it, then it'll probably go gapping and in a big kind of way. But I expect it to be within lines of what the expectations are. So this will most likely be the trappy trap. And I would be looking for traps more than anything else over the next 24 hours and seeing how these markets react. US 100, so of course the NASDAQ here on the futures, you can see that beautiful level. We're not underneath it yet. We mentioned that. I want to move underneath that to show bearish intentions, and we just haven't seen it. We've got the switch. I love that as a short in the last 24 hours. I still think it's an interesting short zone, but I could still see that occurring as well, or even this occurring. And they're the two. I want to see the initial reaction go the wrong way and then reject and then show us, okay, yes, we're going in this one. That's one of the solutions, or one of the kind of thought processes I go through. If you're interested in this type of stuff, put it in the comments down below as well. I'm happy to go through some of my kind of scenarios. I always think of it like chess. In trading, you have to have 4 or 5 different scenarios that maybe statistically will work out these kinds of times. And then you play all of those in your head before it occurs. So when it does happen, you're ready to go and you know how to react to that. If you don't know how to react to that and you don't know what just happened, you don't understand the move. Don't trade it. It's that simple. You don't have to. Don't trade it. It's not like you don't have to always be in the market. You don't have to do anything in particular. So I think that's a really top tip there. Let's look at the SPY. You can see it's in the middle of nowhere land. Basically could be consolidating towards a massive ramp. In my knowledge of history, if you actually end up getting more ramp in between here and then you break out, more likely than not, it usually, if it closes above, usually leads to a full breakout. So we'll be watching that, and it's about 75% of the time. So of course, the closure here will be key. Look at this downward trend line. This is something on the S&P 500 we've seen. Obviously, we get that nice consolidation. We're looking for the breakout up there. US 500. Now, this is where, look at the daily. The daily closes a massive hammer, which certainly looks bullish on the surface. I love that as a short zone. People that took profit here, congrats. You would certainly, if you were a bear, you wanted it underneath here. If you'd got that, you would have been happy. It didn't happen though, but we have some unfilled gaps up here. So we could easily do this. Again, initial reaction could be the false move. And if it is, then we come back down, fill these gaps, and then we maybe think about buyers somewhere in this level. So I like a lot of zones right now. And I think that the reaction to the news is going to be the most interesting thing. Where does it go? How does it end up like 1 to 2 hours later after all the retail people go in there and follow whatever's happening? How are we going to daily close this? Super important. And I'm going to be watching, as I'm sure many of you will. And then hopefully we can react to finding some great positionals. Let's look at the options moving forward. We'll go here to the 14th. So we know that, of course, we've got 420 calls and 412 calls. The maximum pain sitting around 405. We're sitting higher than that at the moment. So technically there's room for the downside. This is almost no options interest though in comparison to what we usually see. So yeah, about that 390 on the bottom end and 412, 420 on the top end at this stage. Now, Bitcoin, congratulations. I saw a few of your comments. You were like, this is accumulation, Tom, because, and I think you're probably correct, it's making a series of high lows. And I technically agree with you there. Once that thing busted here, it was gone. So, if you were looking at this, you were watching it, you had your alerts, and you saw that big closure 2 hours, very easy momentum trade up towards the 30,200. Now, I've spoken about 30,200 for like a month. So we hit a level. I expect reaction here for bears. I really, really do. And I'm actually super interested to know how they end up this week. So we're back in this supply structure over here. And this is where Bitcoin gets super interesting. I am very, very keen to be watching this chart. So even if you hate Bitcoin, this is going to be one to watch. And I think it's just a great technical experience. Sometimes I get excited by things, and I think I'm excited by Bitcoin at where it's at because it's super critical coming into inflation. The way it reacts here, there could be a big move, and I like big moves, and I'm sure you do too. So we'll be watching, and I'd like to see maybe consolidation, even an instant rejection from this level, and then a weekly closure. So many great things could occur to give opportunity in the future. But congrats if you held the 32, or if you're still holding and you feel like there's more. It's a great level, and I'm glad it happened. I mean, there's nothing wrong with it, I guess. This high, nice fake out by the market though when it rejected there. I certainly did start to, I definitely, trimmed. So I think that level there, 28,500 was still a pretty good zone as well after the information came out. But yeah, 30,200 was always my target for this. Let's move over here to the numbers and the data. We've got core CPI, 8:30 a.m. New York time, so make sure to watch out for that. But there's so much stuff. We've got FOMC meeting minutes on Wednesday as well. So you can see here, we're Tuesday first. So don't worry about the Wednesdays coming up soon. So Tuesday first, and then we've got Wednesday core CPI data, which will be interesting. Then we go into the FOMC meeting minutes. And then, of course, we go through to the PPI as well, unemployment claims, core retail sales, and prelim UOM consumer sentiment. So much data plus the bank earnings. It is a bonanza week. Make sure you stick on top of it. Follow us on the social medias. I'll be posting a bunch of information about some of these economic events. You can also get 3 free trading cheat sheets and certainly get involved with the community. Why not? There's so many great people here. And it's all thanks to you guys that we even have this channel. So thanks so much for watching. Smash the like button, subscribe if you enjoy it. We'll see you in the next one. Bye for now.